Friends, I'm making this video by a subscriber's request, and today we're going to talk about the reverse ratio spread strategy. The question came up after I released a video about vertical spread on call options. A subscriber asked why not use a back ratio spread on call options. So I came back to this topic and I suggest we break down the back ratio spread and discuss its disadvantages. After my years of practice, I realized that it is very difficult to make money with the back ratio spread. I made many attempts, but as a rule, the back ratio spread do not give a good profit. Why? Okay, let me explain. Let's work with an asset like Ether today. I'm also going to open up the options calculator and I'm going to pick February Ether options. I'll use call options with a strike of 2,500. I'll sell 100 contracts and then I buy 200 contracts with a strike of 2,600. We have a back ratio spread. The first disadvantage of this strategy is that it is very difficult to construct a back ratio spread with a credit. If you trade options, you know what credit is. We need this P&L profile to be above zero. If the price doesn't fall or rise too much, we should make at least some profit. The credit of this strategy? Give me a second. Yes, the credit for this strategy is zero. As you can understand, it's very difficult to get a back ratio spread with credit, especially if you're working with out-of-the-money options, making aggressive actions out of the money. If you are building a regular ratio spread, you realize that the deeper out of the money your ratio spread is, the cheaper it will cost, and the less risk there's in it. To recap, the risk of a ratio spread is amount of money you paid for it. This strategy looks attractive at first sight. No risk, no nothing. It doesn't matter if the price falls or rises slightly above 2,500, you will lose nothing and gain nothing. That's the idea behind most option strategies. Not taking losses where they would be huge in linear trading. In linear trading, you can get into position, the price drops a lot, and you are forced to close the position. Options allow you to stay in your position and create more complex strategies. We will later look at a similar strategy with later options, such as March series. In this strategy, we expect, for example, that due to the approaching of EDF's approval, the price will make a strong upward move. We expect the price to move up before the approval date. If the approval happens before the deadline, the price may move up even more. The more unexpected the change, the more powerful the price movement. We expect less aggressive price movements when the price scenarios are predictable. So, if Ether breaks the 2,500 level, the price could go even further to 2,700 or 2,800, maybe even 3,000. In this case, the back ratio spread will show good results, but it has one disadvantage. As the price rises, we find ourselves in long position, as if we bought futures. As a result, the following situation can happen. Profit grows, the trader wants to fix it, and his greed will take over. A normal vertical spread has not only a stop loss, but also a take profit. If your price scenario works, you get the maximum possible profit. That's it. No stress, no human factors. But with back ratio spreads, the human factor is in full force. The trader sees, hey, I made $150. Now I'll add the number of contracts for clarity. Okay, the trader looks and sees that he has made $1,500, while the margin requirements are only $350. He fixes the profit, but the price goes even higher. And instead of 3,000, for example, the trader gets half as much. Therefore, the absence of profit limitation is a serious psychological moment for a trader. Yes, you can sell long-distance options, but they're too far away and there's little sense in selling them. They are worthless. An option with a strike of 2,800 is worth $1. What's the point of selling it? It's the same situation with options at strike 2,800. Those options won't improve your position. But there are ways to improve the back ratio spread. I can sell the 2,700 strike options. They're inexpensive, but still. I'll end up with the butterfly strategy, which is not very interesting for us. So, how else does a back ratio spread differ from a regular ratio spread? We have a significant positive vega. This is good if you work with cryptocurrencies, but if you work with the stock market, forget it. In the stock market, back ratio spreads are the most useless thing. Stocks, or worse, stock indices, can easily fall into pit of losses. Assets are rising, you guess the price movement and are happy. But then the price can suddenly move slightly and you fall into the pit, which is not good, as you can understand. In cryptocurrency, the situation is different, more interesting. When the price of an asset rises, we see an increase in volatility. This rarely happens, for example, in the stock market. The strategy will bring us profits not only on delta, but also on vega. Price will rise, volatility will rise. Now, I will change Shift IV for clarity. Volatility will increase by 10. See how much the profile has risen? Or if I choose 20, which is entirely likely to happen, the profile has gotten even higher. This is the obvious benefit of the back ratio spread, which works well in the cryptocurrencies, but poorly in the stock market. For the stock market, a back-put ratio spread is ideal. But there too, volatility can drop, stopping price movements and dropping us into a bed of losses. So now I'm going to return Shift IV to 0. As you can see, the profile changes a lot because of the strong vega influence. So if the normal vertical spread goes in the money, we get into a time decay zone that works for us. The back ratio spread has a negative theta, and if there is a rise after which the price stops, then we, at the point in time, start losing the delta and the premium of the purchased options. P&L tends to 0, so profit should be fixed immediately. Now let's look at the back ratio spread with late option series. With short time frames, it is a bad idea to construct back ratio spreads at all. For back ratio spreads, options with time frame of more than a month or with very high volatility are good. Okay, expiration date, May, new options chart. This window goes here. So in the last strategy, we used options with strike 2500 and 2600. And in this case, I propose to use them too. I sell 1,000 contracts with strike 2,500 and buy 2,000 contracts with strike 2,600. I click on the T price button and there we have our strategy. The not so good point here is that we bought very expensive options. We have no credit, so we have gone into debit. If the price falls or stays where it is, we will have a loss. So this situation is not good at all. That's why I don't like back ratio spreads at all. In this situation, it is better to use a vertical spread with additional sales of put options, or go into ratio spreads with put options. In the later case, we will have a credit, which is what will help us to make money. Let's try cheaper options, for example, with a strike of 2,700. And now the following will happen. The loss pit has gotten even wider. Not 200 points as before, but 400. Yes, we created a break-even zone with a small credit. And now our debit has become negative. i.e. turned into a credit. So if the price doesn't move or falls, we don't lose anything. But in order to make money, we need a very strong price movement. In this strategy, the Vega has become greater. If we highlight this section, we can see that the Vega is almost 5,000. In the previous strategy, the Vega is half as big. So yes, I think it depends on the situation. Strong price moves are very rare. Players do not expect this strong growth, and in their positions they use short squeezes. The strategy is suitable for a specific situation with a strong price increase, but it is a bad idea to use it all the time because of the significant theta that constantly worsens our financial result, even if our price scenario worked and we went into profit. So be careful when choosing this strategy. Let me remind you that the maximum result in this strategy for us is 10 ETH years, as 1,000 contracts are 10 ETH years. Accordingly, we will have to sell 10 ETH years to make money. Okay, let me demonstrate. We want to crop this tail and take profit for ourselves. I take options with a strike of 3,000 and sell 1,000 contracts. I end up with a butterfly. Let's imagine that the price has risen to 2,900. Hence, the call options with strike 3,000 are now worth $147. And now we have added a break-even zone and a take profit of $1,500 to our back ratio spread. If the price goes up even more, we are getting $2,500. So if the price move has already happened, you can use call options on the right to make a take profit. These are my thoughts on the back ratio spread. Use this strategy carefully. Let me know in the comments on which strategies to do a detailed breakdown on. Leave a like for this video, subscribe to the channel, and have a successful options trading.